if you loved Netflix at a market cap of 300 billion, you love it at a market cap of 170 billion. It's gotten crushed.
Oh, but they don't seem to be as popular as they once were, right? Are they
Netflix?
putting out as much content that people are talking about? Like, I just think now I see a lot of people talking about, oh, this show on Hulu, this show on Disney Plus, this show on, other platforms, Fubo TV. Like,
I think that speaks more to how on point Netflix was, because competition comes in.
Oh, for sure.
Right? You get more alternatives, good for the consumer. This ultimately does what? It should put what should it do? It should put downward pressure on pricing. What did Netflix just do? Raise their prices. What it also is going to do ultimately is put downward pressure on margins, right? So
you're going to have people do what I and a lot of my friends do, which is we pay for something for a month, we watch the series, we cancel it, and then a few months later something else comes on, we pay for it, we cancel it.
Wow, you're that guy?
Because there's not things on every single day that Netflix is putting out people are watching.
Wow, you're that guy.
Apple TV's now doing stuff like I'm not going to pay $100 for different streaming services plus regular cable TV for sports.
So it's a scattered market, right? It's scattered.
Pay when you use it.
Scattered. I don't know how to put it all together. I haven't been attracted to Apple yet, or I guess I haven't pulled the trigger on Apple Plus, but I'm a Tom Hanks guy, and that's where he's obviously on contract there. So what do I do?
Buy it for the month.
I'm not that guy, Brett. Although I'll forgive your sins as long as you forgive mine.
That guy, Marcos.
Good morning and welcome to Talk Your Chart with Brett and Marcos. Brett, this morning I am kicking it off with something that's usually the inspiration for most of our charts, which is client conversations. And specifically, this has been given the market client conversations around downward volatility, markets correcting or in correction territory, depending where you're looking. Obviously, there's been a big deviation between kind of the market stalwarts or those companies that make up the biggest percentage of the big indexes. So your Apples, Microsofts, Amazons have gotten banged up, but nowhere near as bad as the smaller technology names, right? So if you've heard of Cathie Wood, for example, she's hit headlines hard with her ARC set of strategies. I think Cathie is super intelligent, has a lot of good ideas, but she's been absolutely crushed over the last year. And since growth investors have been taking excessive victory laps for the last 15 years, value investors are now, I could probably rightfully kind of taking their own little mini victory lap. Although time will tell what happens.
Yeah, this is odd, right? I mean, you had how many times probably in the last few years where you've seen this? Hardly ever. You just had almost a straight run up from tech companies, a straight run up almost with every firm out there, right? Could have thrown a dart at the wall and made a lot of money. So
yeah, precisely. And you can
volatility is very unusual this first few weeks of the year.
Yeah, it's weird. And we had a client who actually, I think, emailed both of us and asked, he didn't necessarily ask about downside volatility. He asked about intraday volatility, which how in the world can we be down 3% and then end up 3%? And the question I posed, because I've gotten that more than once, is if the market falls, but before I had the chance to look, it's recovered, did it ever really fall?
Well, for sure. As long as the media reports that, right? The other day, my wife came screaming home, said the market's down 1,000 points. And then I waited till the end of the day and to see how many of those news stations would actually report that it ended up positive, because they're all pinging red, markets down, and that most of them probably are not going to talk about, hey, by the time it ended, it was up.
Yeah, I'd agree. I guess it only really fell for those that sold, right? Yeah.
Right.
Temperament moves quick. So anyways, what chart do I have today? What we're looking at here is a 10-year chart, 2000 and 2009. Why that time period? Because I want to make a comparison. A lot of people have said, stocks only go up, Marcos. That's what you said. I said, no, not necessarily. Don't forget the lost decade. They said, wait, that's right. The lost decade, when the S&P 500, or to put it more succinctly, when large US companies went nowhere for 10 years. Yeah. And the chart that we're looking at here is taking that exact time period, 2000 and 2009. If you look at the purple line or purple dot, the S&P total return, it actually annualized at negative 0.9% for 10 years, which is a cumulative loss of just over 9%. So wait a second, you literally, it's not just treading water, you were moving backwards.
Right.
And so the question is, how do you avoid the next lost decade? Because although from a probability standpoint, it's low probability, it's obviously an event that would have high magnitude of impact if all your eggs were in that basket. So again, I just said the whole eggs in basket thing. So where does that always end up? With the D word of diversification and the boring academic advisors that we are. But however boring, I still think it's important to readdress this and bring it up again. And I think this chart just kind of helps you look at it. When we build portfolios and we talk diversification, let's be a little bit more specific. We're saying global diversification and diversification across market capitalization, which is the fancy word for how big companies are. So you get your mega caps, Apple, Amazon, and you get your micro caps, the companies you've never heard of.
But just to be clear, this does not guarantee that just because one is down, one of them is up, right? There could be an equal period of time where all 3 or 4 of these are down at the same time.
Brett, I don't think I can even say the G word, right? Like the G word, I don't say that. Do you say the G word a lot? Are you guaranteeing things?
No, but I think the point is when you ask clients, where we have a question, a risk questionnaire, what if you don't get your target rate of return, right? How important is that to you? How fearful are you? And so a lot of clients say that's a high priority for me. When you look at this chart, if you just own the S&P, you clearly have not made your target rate of return because it's probably not negative for a 10-year period of time. And you'd have to, even if you own these other 4, it could be a situation where all 4 of them are down for a 10-year period, right?
It could happen. But let's get real. We're not operating in a realm of certainty. That's why investing is hard, because it's uncertain. The future, by definition, unknowable. So I never say the G word, and I hope you never say it either. Looking at this, here's how you avoided the lost decade. What are we looking at? The orange line is international stocks. The blue line is emerging market stocks, so also international, but in the developing countries. And the green line, small US companies. So by diversifying that big asset allocation, that's ultimately your balance sheet, right? You own a little bit of real estate, you have some cash, right? When we look at a client, we're not just blinders on portfolio only, we're looking at your balance sheet, because ultimately net worth is the target. We want that to get higher over time. From a portfolio standpoint, here's how you do your best to insulate yourself moving forward, and then have a plan. What does that mean? I had a client the other day that said, Marcos, the portfolio in the last 6 months has been stagnant. What's going on? We addressed it. Look what the market's doing. If it keeps falling, we know how we're going to respond. We've determined in peacetime how we're going to operate in wartime. The client that said, yeah, I've invested a ton in crypto and it's down pretty big. I'm kind of figuring it out. Oh, what are you going to do if it continues going? I'm not sure. So this person has no plan whatsoever, has no frame of reference for what he's going to do with the speculative investment he has. And he's looking at the portfolio we manage saying, wait, what are you guys doing there? Is there something wrong here?
But that's the difference. The difference is with cryptocurrency and even with individual stocks, if they're down, I can't say that for certain they're going to bounce back. We know from history that the S&P 500, the markets in total, have always hit newer highs after they've dropped. So when we've rebalanced, like you said, and when the S&P has had a bad 10 years, what happened in the next 10 years after that? Phenomenal results, right? And so that's why I think the rebalancing that we do is so much different than a rebalancing that a client should do with cryptocurrency or individual stocks.
Yep. That's my spiel, man. That's it. Oh, the last thing I say, because we mentioned crypto, hot topic. I'm not putting too much in it, but I'm still 20 years bullish on the metaverse.
I'm a little happy that it's down 50% in the last few months. I can't lie, but
you better be prepared for that. That's what crypto does.
Right.
If you're not hodling, if your laser eyes are not firing right now, I'll say the thing again. I'll be repetitive. If you loved it at 60,
I still hate it at 30.
No. Oh my gosh. What do you got?
I want to talk about the word of the day for me is expectations, because I think what I've seen over the last few weeks is some things that maybe have surprised investors that they really shouldn't be surprised by. And it's all because of expectations. So what do we know over the last few days is there's been a lot of earnings reports. So I'll start with a couple different earnings reports that have come out. I'm going to ask you a question here. Last night, both Caterpillar and Chevron have come out. Caterpillar producing a lot of bulldozing and stuff, equipment like that. Chevron, obviously a big gas company. Caterpillar reported fourth quarter profit of $122 million, a 27% increase over fourth quarter of 2020. Chevron reported earnings of $5.1 billion, which was compared to a loss of $600 million in the fourth quarter of 2020. So both phenomenal numbers, right? Earnings that just blew the socks out of what they did a year ago. And this is after expenses, not just revenue, it's net profit.
Okay.
What do you think those stocks are done so far today?
But can I ask a follow-up question? I just have to say, I have to give an answer.
Yeah, go ahead.
All that information that you gave us was looking in the rearview mirror. What was the guidance, dude?
Exactly.
What was the guidance?
So that to me tells me nothing about what the stock did. Both stocks actually pre-market are down 4%. Okay. So when a client tells me, hear it all the time, I'm sure you do as well. Clients say, I want to buy XYZ stock. Why? They're going to make a lot of money. They're going to sell a lot of widgets, cars, whatever it may be, credit cards, houses. That doesn't matter, right? Because there's already expectations built in on these companies. If they don't keep up with those and they don't have good future results, it's not going to matter what they did in the past. And so I'll turn to something that happened 2 weeks ago, a mind-numbing number, which was inflation came out, right? The CPI, Consumer Price Index,
okay.
The highest number since 1982.
Yep.
Since you were not even born at that point. I was a wee little person.
Correct.
7% was the number. And what happened? That day the number came out, you would have thought people would be panicking, right in the street. 7%, oh my God. That morning, the S&P, Dow, and NASDAQ were all positive after they put out these results. Why do you think that is?
Versus, you got to be forward looking. And you said, what year was it?
It was most since 1982.
Since 1982. So we know what the 70s did to stocks, right? With inflation. I know for a fact that, yeah, exactly. I just pulled it up here. What was the average annualized return in the 1980s for stocks? It was 17%. That's pretty good above the long-term average of 10% per year. So inflation averaged 5.5% in the 1980s. And guess what? 17% annualized, not too bad. Yeah.
Well, I think if people are expecting it to happen, there really should not be a big market movement. If people are expecting the Fed to raise interest rates 3 times this year, if people are expecting unemployment to drop, if people are expecting, gas prices to come down, for supply and demand to resolve itself, the market shouldn't be surprised when those things happen.
I agree with you, but here's what I also tell you. And it goes back to this, and it took me a while to wrap my head around this, the market's forward-looking thing. It's the same with interest rates. And what's super duper interesting, and maybe it's a chart we can show next time, when the Fed actually raises rates, on average, the market is up because the falling happens before the rates jumps actually happen,
right? Because
the market is pricing it in,
right?
Yeah, everyone's saying
when that happens, because
yeah,
I expected it
precisely. So that's what's happening now. And why do at least my opinion, why it's happening now? Because our good friend Jay Powell, he kind of escalated things at the end of the year a little bit because we went from 1 increase this year to 4 in kind of successive meetings. So that was a little bit surprising to everybody. But I think what he has now is a little bit more room to be slightly more dovish because he's gotten a correction in markets and may not need to see it. I also think they took the pedal off the transitory word at the wrong time. Like right when I think you might actually get some transitory reality over the next couple quarters, they walk back from the T word.
It could be, but the S word that you use, surprise, to me tells the whole story. That's why the market's gone crazy the last few months, because now we just don't know. Is it going to be 3 rate hikes, 4, 5? Is it going to be 0.5% rate hikes? Are there going to be any? Are we going to find that 3 months from now, we don't have a supply and demand issue anymore? So when it comes to expectations, I think that rules the day. And something you said last Talk Your Chart, I've got a bone to pick with. Okay, we were talking about 2 stocks that we think can do well in 2022.
It was right? Verizon and who?
JP Morgan Chase. You picked JP Morgan Chase. Why? Because you expected interest rates to rise, and that will benefit financials.
Yep.
If everything we just talked about today is correct, And if the market is expecting interest rates to rise, that should already be priced into JP Morgan's price, because they know that going forward, revenue should be higher for loans and for things of that nature.
Look, man, I'm gonna tell you something right now. I told you the forward-looking thing is hard, and I'm still wrapping my head around it. But I just pulled it up right now. Although both Verizon and JP Morgan are outperforming the S&P, JP Morgan's doing way less well than Verizon is. So I'm down 7.5% on the year. You're down 32 basis points. I think we can still stage a meaningful recovery. Let's go JP Morgan. Let's go Jamie Dimon.
That's fine. I would just conclude by saying what we think is going to happen. You need to be surprised on the upside or the downside for that thing to cause a reaction in the market. And so just saying that rates are going to rise, so that'll benefit certain companies, or oil will fall, that'll benefit other companies. That's not enough, because those prices are already based on everything you or I know from expectations.
I agree with you. And I think this is also why the reality is the real best hedge against inflation is definitely stocks in the long term. But if you're looking for the panacea of the short-term hedge, it's tips, and it's really only tips, because that is primarily purposed for what you just said, surprise inflation, right?
Okay, let's touch on tips next time.
Fine.
We got to wrap it up today.
Okay, I got one last thing to say. I'm sorry. One last thing. So the lost decade, how do you protect? By being invested before the lost decade happens. So wait a second. The 2000s, the average return was negative. What was the average return in the 90s? 18%. In the 80s, 17%. In the 70s, 6%. Stay invested.
What about the 2010s? 2010s have got to be double digits as well.
13.4, baby.
There you go.
I know. All right, BH. Thank you, man.
Have a good day.